Welcome back to the training on risk appetite. In this section, we talk about the understanding of risk appetite as a key component. When talking about risk appetite with bankers or anybody who thinks is a banker or has some financial experience, a lot is revealed in this conversation about the actual way how this person understands what the core concepts of providing financial services and by that, taking risks actually entails. Risks are primarily uncertainty, making decisions without having perfect information about the future. When taking risks, you accept to make losses, but in the end, you consider the probability of making a loss acceptable against the perspective of gaining profits. Taking risks is very different from actually gambling. In general, gambling has a negative expected value. We know that the casino which offers the gambling will ultimately always win. Otherwise, there would be no incentive for the casino to open its doors. Taking risks as a banker cannot be based on the same concept as that of a gambler. Taking risks as a banker means, first of all, eliminating all uncertainties to the best extent possible. Eliminate the sources of unforced errors, of making stupid decisions due to the lack of thorough analysis. And once you have eliminated the sources of, we call it avoidable mistakes, you're still left with a lot of uncertainties, but they are the ones you might be willing to accept if the risk-return relationship is adequate. There are, of course, a lot of books talking about risk concepts, how bias, overconfidence, and misinterpretation of data leads to unnecessarily and excessive risk-taking, and thereby higher losses. One aspect which I believe is often missed out in the thoughts about taking risks is the assessment of opportunities, specifically when we talk about lending products. Because think about it, your upside as a lender is very limited because the best thing that can happen to you is you get your money back. If you are a lender, you are in a very different position as compared to, for example, a venture capital investor. The VC often spreads the money across 20 investments and expects that maybe one or two successful projects will compensate for all the losses you experience with the other 18 or 19 investments. As a lender, you are in a far less exciting environment. If you make 20 loans, those companies that default, they will not make you repayment. They will not send your money back. They will create losses for you. The companies that perform on average, well, they will pay your money back. And those companies which really take off, have exciting growth, become unicorns or whatever, are far more valuable, will become the shining stars. They will also just pay you the money back. So your risk-return relationship for a lender is very skewed. You have all the downside with very little upside. And that's basically what you need to reflect in your risk appetite. I personally really like the expression of a risk appetite as it makes the concept of defining how much risk you're willing to take quite transparent. As human beings, we all understand the concept of appetite and being hungry. And there's also a lot of research around the appetite, and in recent years it seems that anybody with access to social media can also become an expert on nutrition. But for the purpose of this video, let's just stick with science first. Let's think about appetite. What are the characteristics of an appetite for human beings? And how does this compare to the risk appetite of a financial institution? First, there is the psychological drive. Appetite is a natural thing, an instinctual drive that encourages the consumption of food to meet the body's energy and nutritional needs. It's influenced by signals from your brain, from the hormones, from the digestive system. Compare this to a financial institution. Taking risks is an essential source of revenues for the financial institution. Not taking any risks means not generating revenues. And obviously, not generating revenues means starving. There's also the psychological influence. Appetite can be influenced by emotions, by stress, by mental states, even by jet lag. For example, people may feel more or less hungry when they're stressed, when they're anxious, or experiencing emotional highs and lows. Such emotions can also be experienced in the financial institution. Imagine that you are below budget on your performance. This can be a great motivator to push your risk tolerance. Think about it. You realize by the end of the third quarter that you're lurking far behind your budget, but you also know a little more effort and a little more lending and a little more risk tolerance could bring you back on track and make you eligible for this really juicy year-end bonus payment. This is the ideal precondition for taking risks beyond your general tolerance. Appetite is often triggered or enhanced by, as we call it, external sensory cues, such as the smell or the taste of food. These cues can increase your desire to eat, even if the body doesn't really need the energy at that moment. A similar case happens for financial institutions, a sensory response related to the trends and comparisons to other institutions. At least the way other institutions communicate about their own performance. As a management of a financial institution or as a board, we are not prone to FOMO, the fear of missing out. The bank's management doesn't want to look silly when they miss out on a trend during the next board meeting, where the board members compare your performance to everybody else and think that you're not doing the right thing by pushing your risk appetite. And finally, there's also the behavioral components. Appetite is not about physical hunger. It also involves behavioral patterns related to eating habits, preferences, cultural or social context that shapes when you eat. Think about it, your regular Sunday lunch, your dinner with colleagues. You might not be hungry, but you feel that this is an obligation to join and eat. Same for financial institutions. There might be a specific risk cultures or business models that drive your appetite. You always participated in a transaction. You always participate in the renewal of a loan to a specific company. So you participate even if it might not be in line with your appetite. All these factors are all pretty straightforward and understandable for the common sense. We understand about appetite. We can follow the logic. But yet, we're also exposed over the last year to a trend in social media of influencers who have their own perspective on nutrition. They have their theories about diets, about preferences. And for the average person, it's very difficult to really verify whether these recommendations or these concepts are substantiated by science or whether they're even proven by the same people who referred them. But because appetite and food and nutrition and healthy bodies are such a popular concept, everybody has an opinion about it. And this is similar to financial institutions. So many people have an opinion, a perspective, an argument about why specific risks are worth taking, which opportunities to invest in, or how to allocate the scarce resource of equity capital. What can go wrong? This, however, usually comes from people with little experience or little long-term incentives in their decision making. Experience as such is usually highly undervalued by such colleagues. Yet, on the other hand, we actually know that experience is the most important factor that helps you to define the right risk appetite. Think about the person who has been obese and at some stage took a turn realizing that there is a very important component of having a healthy body. This person changed its diet towards a more nutritious food. The person started to exercise, started to use significant discipline to change. And this person has shown tremendous progress, became much more healthy, became much more attractive, and also became much more focused on its work. This is the person that you probably like to rely on when learning about the benefits of having the right appetite, not just some influencer or some opinion coming from somebody with the wrong incentives. There are lots of experiences in the financial sector about difficult situations, crises or losses, which help you shaping the approach towards defining and understanding the risk appetite. I usually prefer if somebody who has lived through a crisis, who has experienced some losses, and has learned the lessons to give me the advice about the right risk-taking approach. Now, once you have established the specific appetite, and with this training we try to help you in the process of learning about establishing the risk appetite, you will see a number of benefits. You will make significant better decisions. You will cluster your observations into a much clearer framework for your own decision making. You will be able to project decisions against your objectives, and you will be able to withstand ad hoc decisions driven by trends or by competitors, or in the worst case by the fear of missing out. You will be smarter, and you will also have a much better allocation of your resources. You can continuously identify where to make the best allocation of your equity. You will have your decision trees. You will have your allocation of equity so that you can take the risks where you think and where you calculate that there will be the biggest return impact. On top of that, you are creating a really strong risk culture, probably the most important ingredient for the success of your bank. Your team becomes more risk aware, has clear expectations, and makes decisions in line with the nature of your business. Your team will understand the value of good analysis, of eliminating uncertainties and diligent executions. There is a component of success of making a good transaction that repays on time and makes the customer a successful business. And in this way, the team will not be distracted from short-term trends or opinions. There's of course always the challenge that while your team is very well trained and educated in risk appetite, disciplined and thorough, but then come the stakeholders, the board, the credit or investment committee, which has certain expectations, which might not be as well furnished with the same thoroughness. Here, you run into tremendous amount of conflicts. And the only way to really get through these conflicts is to maintain your disciplined approach. This is why it's important to establish a risk appetite framework from the top with ongoing training, ongoing communication, ongoing examples how the well-developed and well-documented approach to risk has really paid off for your institution. Unfortunately, you will always be exposed to a specific bias. People always have selected memory. And if you are, as a risk manager, decline a transaction which turns out to be really bad, nobody will remember that. However, if you turn down a decision that results in a transaction which has become very successful for a competitor, then it will always be used against you in the conversation for a very long time. However, even with this bias or with this problem, it will not hold us up now to continue our training. In the next section, we will start with definitions. This will be followed thereafter by explanations on how to develop the risk appetite statement. We hope you liked the training so far. Please give us your comments, please give us your feedback, and please continue with the training in the next video.